It's going to be a base-filled year. The flipping's still on the table. LSTFi is going to be the chief narrative. I strongly agree with that take, Westy. And CCTP is going to eat the bridges.
All right, everyone. Welcome back to another episode of 0x Research. This show is made possible thanks to our wonderful sponsor, the Accelerator. It has never been a more attractive time to build in the cosmos. If you're a contributor looking for grants, the Accelerator offers grants between $10,000 and $1 million. So be sure to check out the link in the show notes. Today is May 31st, and we have a really fun episode today lined up with the Blockworks research team. We're going to start out with a little segment of hot seat, cool throne, and then transition over to some predictions for the back half of 2023. Westy, why don't I kick it over to you for your hot seat or cool throne?
Yeah, sounds good. So yeah, on the day of this recording, May 31st, I have actually OP in the hot seat because today it saw its largest unlock equivalent to that of roughly 114% of the current circulating supply. So obviously a giant unlock, and this caused the token to dump roughly 17% over the past few days in anticipation of this unlock, and hasn't really seen a bounce since it's happened. And this is also the start of sort of the vesting unlock in general, where I think every month from now on until sometime in 2027, we're going to see 0.5% of the total supply being unlocked every month. And so, yeah, a big overhang for OP, pretty bad trading week for OP. And I just wonder, we have like a lot of upcoming events for Optimism. So the Bedrock upgrade this week. We have World Coins launch, I think, in June, and then Basis testnet pretty soon. And so I wonder, like, is this enough to cause a bounce after the unlock, or will the overhangs over time also be a little too much as liquidity is pretty dry at the moment?
Yeah, I agree that the unlock is pretty big. I think I saw a thread out there that said historically some foundations or teams have tried to time these unlocks with protocol upgrades. So, for example, the unlock is coming out today, and Bedrock is supposed to come out, I think, on June 7th or maybe June 11th. I'm not too sure, but within the next 2 weeks. I think another thing that I think about when it comes to token unlockings is that in Web 2, like in that world, the same thing happens, like you have startup founders, they get vested equity, they have like a 1-year cliff, the equity vests over 4 years, and the only thing is that they can't sell it until an IPO. And if you kind of think about it, I'm not really sure that makes sense. For example, if you stay at a startup for 3 years, you've done an amazing job of bringing it to market, but just because of how like traditional public markets work, you have to wait 10 more years for an IPO to happen, and only then can you sort of like receive your compensation or your upside in helping build out their product. I'm not sure that's the best model and the best incentives, but also you have the converse argument, right? In crypto, these large unlocks, it means everyone can dump early, but I feel like that's mostly a function of the market not being efficient and pricing everything too highly, right? The valuations are too high, and that's enabling these founders to basically unlock and dump these token high valuations and cash out without their product having reached any semblance of product market fit. If the valuations were much lower, sure, people would whine because like the token price doesn't go up. But also I think that would make a lot more sense in terms of like equity / token being liquid upon vesting in a crypto context.
Yeah, I agree with that, Ren. I'm also just like you said, Westy, all the catalysts coming up. Like we have base mainnet coming pretty soon, Bedrock. We've got World Coin. Like it's kind of, to me, gonna shape out like maybe more so how the Cosmos ecosystem did, in that like the hub isn't necessarily the central value accrual token with Atom, and maybe OP becomes the same. I think a lot of that will probably hinge on whether every OP stack chain actually returns some of the revenue from the sequencer back to the OP public goods funding, because that is a pretty enticing flywheel right there if it becomes a standard, kind of how airdropping tokens to Atom stakers did over in the Cosmos. But yeah, definitely tough to see how it plays out, considering every OP stack chain is going to have their own centralized sequencer.
Yeah. Good thing to bring out and point up, Westy. I like that one. Ren, what do you got this week?
This week I have Tiger Global in the hot seat. So in November 2021, they invested 555 million into Moonpay at a 3.4 billion dollar valuation. For those that are unfamiliar, Moonpay is sort of an on-ramp, off-ramp service provider, so to say. Tiger Global launched this $12.7 billion venture fund at October 2021, which was kind of peak bull market, and they deployed, I would guess from that fund, a lot of it into Moonpay. By the end of 2022, that fund had a paper loss of 20%. And it basically got spewed out that Moonpay sort of siphoned 150 million out of the company for their own use. The CEO bought a $38 million mansion in Miami. And Kobe also came out last night saying that at one point he got an intro to the head of Tiger to help them with their investments because he was like, "What are you guys doing? Like, your investments are garbage." And basically, the head of Tiger said hi, ignored all of Kobe's messages, and then left the Telegram chat and basically ignored Kobe for good. So I think the moral of the story here is that over the past 1 or 2 years, we've seen a lot of companies deploy a huge amount of large checks into like quote unquote established or larger crypto companies, FTX being the most notable one. Celsius with that Canadian pension fund investing $150 million into that. And a lot of these have been at absurdly high valuations, right? Like $3.4 billion for a Series A is pretty unheard of in the Web2 world. But perhaps one could also make an argument based on some funky math, say, hey, if 10 years down the road, 1 billion people in the world use crypto and X% of them need to on-ramp, off-ramp, and they don't want to do it through a centralized exchange account. Moonpay will facilitate that. Moonpay will take X% of that on-ramping. Then perhaps you can arrive at like a magical $3.4 billion valuation. But overall, that still seems high to me. I think another news that came out over the past week was that the people that invested in FTX out of the Singapore pension fund, they got their pay cut by a pretty hefty amount. So I guess there is some accountability out there rather than just like randomly chucking checks at these companies, right? But then there's also been arguments, right? As a VC, sometimes you do need these VCs that are a bit further out on the risk curve to fund these sort of like industry changing, paradigm shifting companies. And if everyone that works at a VC rather prefers to play it safe by not funding these type of companies, it's very possible that a lot of like sort of the $100 billion companies we see today just don't exist because everyone in VCs become risk averse and they don't want to invest in like the next Celsius, the next FTX, and the next Moonpay. So yeah, but I have Tiger Global on the hot seat because they ignored Kobe.
Yeah, definitely a bad look for the industry as a whole, honestly. Like seeing these larger players get wrapped up in these types of scenarios is pretty brutal. I mean, the TLDR is like do your due diligence. Surely a firm of that quality would have been able to dig in a little bit, do some DD like they do for every other investment they've made, and kind of arrive at a conclusion that maybe this is a bad call. But clearly that didn't happen. So you'd have to wonder is like, were they just trying to be like, okay, we got to allocate to crypto instead of doing the protocols themselves? Let's kind of hit the on-off ramp space. Maybe that's a little safer. Like we just got to be in this space because our LPs are demanding it. But it's just not really where we want to be. That's kind of what I think would have happened. But again, I wasn't sitting in that room, so I truly have no idea.
Yeah, I'm just still salty at Moonpay because I tried to buy Pepe at like a $20 million market cap on the Uniswap mobile app, and I got my transaction denied. So they single-handedly screwed me out of $15,000. So yeah, I think that's a good hot seat there, and but I can take it over for my cool throne. I've actually got the Noble and Celestia partnership. So Noble is the general asset issuance chain in the Cosmos ecosystem, and then Celestia is a DA layer that's building using the Cosmos stack, and they are enabling the minting of native USDC by default for any modular chain that leverages Celestia as a DA layer. This is really important for a lot of different reasons. Basically, in order to have a vibrant DeFi ecosystem, stablecoins are incredibly important. And that's been a main pain point for the Cosmos, actually. But now that they have USDC, I feel like there's going to be a lot less liquidity fragmentation. It'll be easier to bootstrap a solid DeFi ecosystem. There's even talk about using USDC as gas tokens for these modular sovereign rollups. So super exciting development. I'm not really sure how exactly it plays out, but I'm curious to get your guys' thoughts on what do you think the main use case for sovereign rollups will be?
Yeah, I definitely think that this is a huge development. I mean, you look at Cosmos, I feel like the reason that their DeFi hasn't taken off despite them being around for a while is because there wasn't that like native stablecoin. And like you said, there was that fragmented liquidity. And now that you know that Celestia off the bat is going to have native USDC there, like with the ability to use it, I think that's going to supercharge a lot of the growth in Celestia to start where maybe otherwise they sort of had like a slow start over time. I think that's really going to jumpstart things. And I do think that's a good question. What the main use for sovereign rollups will be. I think like using Celestia as a DA layer, which is going to be a lot cheaper than even Ethereum under dank sharding. Like I think there's going to be a lot of really cool use cases, specifically like ZK sovereign rollups on Celestia, where they can post proofs like continuously to the DA layer and have like really quick block times, synchronous composability across different rollups with something like the Sovereign SDK that's being built. Like I think there's going to be a lot of really cool use cases, high throughput use cases, and I think to be honest, like that's where the rollup vision that we all think of, where you have many different rollups that are all composable with one another. I think that's where there will happen is on Celestia through these sovereign rollups.
One thing that's interesting is the fact that USDC will have such a first mover advantage as the native fiat stablecoin. Presumably Tether's thinking, hey, we got to, copycat, follow in these footsteps, but we haven't seen any of those actions being taken. So it's interesting to think about, right? Because everybody over the last 6-12 months has been like, all right, there's like three major ecosystems: the high throughput chains like Solana, Ethereum, and app chains through the Cosmos ecosystem. And so the fact that we already have USDC and Tether on Solana, but and obviously it's very much so perforated on Ethereum itself as well as Ethereum's L2s. We haven't really seen that happen in the Cosmos ecosystem, and so I wonder, like, if we do get this Cambrian explosion of DeFi applications and use cases, now we have Mars to offer leverage, Neutron's coming, and providing that general purpose area to come build DeFi applications. And if we do start moving in this world, it's like, is this going to be a miss for Tether is kind of where I'm thinking. And it's definitely good for DeFi to have, that trustworthy fiat stablecoin that can provide that one-to-one pegged value. But, you almost kind of want that market diversity to kind of shard some of the risk of relying on a single asset. So I'm curious to see how that plays out from more of this stablecoin view.
Yeah, that's a good point. Sorry, go ahead, Ren.
No, I was going to say, it seems like Tether is leaning very heavily into sort of all of its Bitcoin operations, between the buying of Bitcoin using its interest income and also starting its mining operations in Uruguay. I haven't seen anything infrastructure related, like in terms of on-chain infrastructure from Tether at all, whereas Circus is just running circles around everyone with the launch of CCTP, and then now with USDC being able to be natively minted on the Celestia chains and Cosmos chains. I think one thing that I never really thought about was that, like, what do wrapped assets like even look like on a sovereign rollup, right? Assuming they all use like a DA layer, like assuming USDC doesn't kind of natively mint USDC. Assuming Circle doesn't natively mint USDC on the DA layer for a sovereign rollup, right? Like the people have to bridge from Ethereum to the DA layer, and then that like bridges down to the sovereign rollup. Like that gets like really messy. And of all of the use cases that I envision for sovereign rollups, I think there's a lot of them that are either kind of like institutions or like mass adoption, sort of like, for example, DePIN applications. And most of those would want a stable coin, right? You don't want people to transact for your business or for your DePIN protocol in like ETH or maybe even a native token. Like you still want that payment to be made in a stable coin, or at least like something US dollar denominated. So I think USDC coming to all of these chains natively is a pretty big unlock. And of course, there's a whole sort of discussion that sparked over the weekend from John Sharp's like roll-ups piece, like what is a roll-up? And I think that has given a lot of us sort of a bit of food for thought into the differences between a native asset and a wrapped asset on a roll-up and what that really means when like shit goes wrong, for lack of a better term.
Yeah, good point. Things to point out, Ren. I guess I can give my hot seat cool throne this week, but honestly, I think I'm gonna have to leave this one to the audience to decide if it's a hot seat or a cool throne. I'm bringing MakerDAO to the table for their continued development and building. The end game has been largely in discussion, and I think most people still don't really get what it is. But we're starting to see the cards unfold and into what that direction looks like. And the kind of initial steps of building out this plan are centered around this borrowing rate increase for MakerDAO itself. So a couple big changes that are coming that I'm going to walk through real quick here. So through MakerDAO's RWA exposure, they're earning essentially the risk-free rate provided by the U.S. Treasury through their exposure to T-bills. And they are now returning some of that yield to the DAI stablecoin itself as what they call the DAI savings rate. So this proposal that is set to go live in a few days actually brings a 3.49% yield to DAI. They are calling this like the DSR, again, the DAI savings rate. And so this brings a very interesting change to the ecosystem because we haven't really seen the ability to earn on-chain yield at scale before specifically from T-bills. And so now with MakerDAO supplying this, there's a few major changes that also come along with this around increasing the cost of borrowing from on-chain collateral. So examples of that are like borrowing against your ETH through Oasis or borrowing against your wrap staked ETH in Spark protocol. So that is a very interesting diversion they're making, is saying, hey, we're going to provide native yield to the DAI stablecoin itself. However, we're going to charge you more on your on-chain collateral borrowing. So very, very interesting, because a lot of the MakerDAO team themselves is like, this is going to completely change DeFi. The cost of borrowing is going to go up specifically for DAI, but also for other stablecoins. And let's walk through why they believe that to be the case. So specifically for DAI, on Aave, the borrow rate is roughly 3-ish%, let's call it. And if that is below the DAI savings rate, then there's this very obvious carry trade or arbitrage that can be captured, where I provide collateral to Aave, I borrow DAI against that collateral, and then I just take that DAI and plug it into the DAI savings rate, and then I earn the spread between what I'm paying for the loan versus what MakerDAO is paying me. So that gap will get closed, and DAI will become more expensive to borrow on Aave. So this is effectively pulling up the cost to borrow for all DAI stablecoins across the entire DeFi ecosystem. Now, you could also say the same thing will happen to USDC, right? Because there's kind of the ability, the PSM creates that gap where I can just borrow USDC from Aave, use the PSM to flip it into DAI, and then collect that savings rate again. And then the increased demand to do so will kind of close that gap as people come in and take advantage of that. Now, one thing that I personally think that is getting overthought of in this is specifically a peer-to-pool borrowing model, where suppliers deposit assets to earn yields that's generated from borrowers coming to the same protocol and taking out loans against that collateral and paying interest on those loans to do so. That will increase the borrow rate for those protocols, but we have two scalable models in DeFi. That's the peer-to-pool. But the peer-to-protocol, similar to what MakerDAO is doing, the protocol itself is responsible for creating the rate that people can borrow against. So an example of this is Curve's new stablecoin. That is it's a bit of a complicated formula. We can walk through at another time, but essentially there is a market rate that isn't determined by anybody else. It's called rate zero, is this specific thing I'm referring to. And that determines where this curve sits. And it doesn't matter what the cost to borrow DAI is in this model, in my opinion. I don't see how that's going to try to impact this rate. But I think it will bring some interesting changes to DeFi. I kind of think some of the MakerDAO team is overstating the impact it'll have. And then again, this is crypto in a bear market, so nothing is efficient in the first place. But yeah, I'm curious to get your guys' take around how you think increasing the DSR to 3.49%, as well as increasing the cost to borrow against ETH and ETH derivative collateral. What kind of changes you expect that to bring to DeFi?
Yeah, I think you brought up a great point in that it's going to increase the bar rate of DAI on these external sort of like pool to protocol or peer to pool models, as you said. But Maker themselves sets their own interest rates. And so you can imagine in the future, and this is the take of Effort Capital, fellow analyst of ours, and I agree with it fully, is that as they continue to scale up their RWAs, you can imagine that the DAI savings rate gets above the risk-free rate in TradFi. And then as a result, Maker can say, hey, we're going to basically rug all the interest rates on our other loans, on our ETH-backed loan, et cetera. And so DAI becomes extremely cheap to borrow within Maker itself. And DAI has a really, really high savings rate for higher adoption within DeFi. So yeah, I think this is a really strong move for Maker. And I think, yeah, like you said, it's going to bring up the rates within DeFi, force other people to be more competitive. And I think overall, it's going to be good for adoption of Maker and DeFi as a whole.
Yeah, one thing to expand on that you just brought up, which is pretty interesting, is this kind of becomes like a hurdle rate or an on-chain risk-free rate. It's like if I can just do nothing and get paid by staking my DAI or swapping it to SDAI, is this like DSR accruing version of DAI, and if I could do nothing and just earn that, that becomes a bit more interesting to be like, all right, so let's say I own Frax, now I have to go like, stake that through a curve pool, put that into convex, and get like CRV and CVX and FXS yield, turn that into like another stable coin to like kind of capture that yield. That's like a lot of work as opposed to just staking DAI. So this does definitely make a very interesting use case for like this baseline hurdle rate or baseline risk-free rate across DeFi, which I do think is kind of what the Maker guys are referring to when they mention the impact it's going to have across all of the DeFi ecosystem.
I think one thing that I think about when it comes to risk-free rate is that will crypto ever have its own risk-free rate? Like in TradFi, everyone knows the risk-free rate is the rate that you get on the US Treasury bill or like the current federal funds rate. But crypto, I think for a decent amount of us, represents like a paradigm shift, right? Maybe there's a world in which we have two different types of risk-free rates. One is ETH denominated risk-free rates, and one is US dollars denominated risk-free rates. Maybe there's a world where when TradFi eventually comes on chain in size, there's a different rate curve on chain than off chain, just due to external factors such as smart contract risk, or maybe there's a lower risk-free rate on chain compared to off chain because I don't know, maybe there's no counterparties on chain and people think that that's less risky than your counterparty being the United States government. I think that's a very interesting discussion for people to have, and I don't think it'll be even too surprising if, at least for now, people in crypto think of risk-free rate as the ETH staking yield, for example, and then apply that to the US dollar. So okay, the ETH staking yield is 5%. Now my US dollar risk-free rate is 5%, even though ETH is a volatile asset and US dollar is like $1 US. I think there's a lot of mental models that are interesting to think about. But at the end of the day, risk-free rate is basically social consensus. It's what the world and the larger society thinks the risk-free rate is. So it'll be interesting to see that discussion continue as crypto develops. And I think the answer to that depends on whether TradFi and institutions come in size or not on chain in the next 5-10 years.
Yeah, I agree with that, Ren. That's like a really interesting psychological question. I think it's going to take a lot of time before people actually accept a crypto denominated asset as a risk-free rate. But I do think one day we will see that world. But Dan, you want to tell us what's new at the Atom Accelerator?
Absolutely. As always, we got to give a shout out to our wonderful sponsors over at the Atom Accelerator. Again, the message we really want to bring to everyone today is if you're a developer, the place to build is quickly becoming the Atom economic zone. with again, we actually put Neutron in Noble in the Cool Throne this week because of everything they're doing. The idea of building on this new bustling hub of DeFi is super powerful. And again, with native USDC coming to the Cosmos, it kind of unlocks the ability to build new and exciting products that really haven't had that stable form of value to be practical in the past. And with technology like IBC giving you the flexibility of interoperability with other chains across the ecosystem, you kind of get this mesh type network of app chains that can all communicate with each other and build exciting products. And so again, as Sam mentioned earlier, the Atom Accelerator is giving grants from $10,000 to $1 million. And really kind of doing that on a rolling monthly basis to incentivize people that are like, hey, we have this crazy idea. We think it's going to be great for the ecosystem, but we kind of need some capital help building this thing out. And so the Atom Accelerator is here to bring those things to fruition. So if that is something that you're interested in doing, be sure to check out the link in the show notes. We've got a great way. They have a great website to kind of help guide you through what the process of getting involved looks like. So with that, be sure to check out the Atom Accelerator. And so moving into the back half of the show, I want to talk about some 2023 predictions that our team has for what we expect to see in DeFi as well as all across the crypto ecosystem. So at the start of the year, we did an episode where we talked about some things or some ideas we had about what's coming for the next year. And we wrote a report on this that's live for free on the Blockworks research website. We'll link that in the show notes as well. But we kind of take a second to review some of these. Some of them have certainly fallen apart, but others look quite good. And I think we want to hit on both notes. So Sam, let me pick on you first here. I'd love to hear about your thoughts about what you have in mind for the back half of the year. And if you held this idea or thought at the beginning of the year.
Yeah, so I think my 2023 prediction from the episode back in, I think it was the end of December, early January, I think I actually said that a major OG DeFi protocol would launch as an L3 somewhere in some ecosystem. So obviously that has not come to fruition yet. Still got quite a bit of time. I don't really have as high conviction on that statement as before. I feel like back then everyone was talking about L3s, and right now it's more OP stack and modular stuff. So we'll see if that vision actually comes to fruition. But for this prediction for the back half of 2023, I'm going to go with base alts outperforming the market. So base is set to launch on mainnet sometime within the next couple months, basically just waiting on a few things from the OP foundation to get launched live, one of which being Bedrock. But I'm just anticipating a large swath of activity on base in the months following mainnet launch, given just Coinbase's app, their wallet, large number of verified users. We've talked about this ad nauseum, to be honest. I also just think there's going to be a ton of development coming directly from the Coinbase team themselves, building dApps that could potentially be monetized in some way for Coinbase, the company. So I think there'll be quite a bit to do over there. Not super confident that they'll have a very vibrant DeFi ecosystem, just given how, regulatory purview under DeFi, I feel like those two don't exactly cross too well. So I'm expecting more things like maybe social applications, gaming, payments, things of that nature. With Coinbase Pay, I feel like payments has high potential. But yeah, I mean, back in 2021 or so, you saw Matic rip super hard, BNB, Sol, all these L1 tokens. But for Arbitrum, it was GMX, because obviously Arbitrum did not have a token at that point. So I just feel like there's going to be speculation, and it can't be on base token because there is going to be no such token. So I do think alts over there will perform pretty well. Obviously, the main risk here being execution, maybe a lack of interest from users because there is no token, because I think everyone ultimately knew eventually there's going to be an Arbitrum token, and for base it's going to be the opposite. Not sure exactly how that influences things. And then also regulatory risk, as Coinbase being the sole sequencer operator. I'm very curious to see if the SEC comes at them from that angle. But nonetheless, I think it's a pretty solid bet going into the back half of the year.
Yeah, I'm a pretty big fan of that bet. Yeah, like you said, there's a lot of interest on the developer side of things in terms of base. So there's a lot of projects that want to build there. And that's because Coinbase has all the users that they do have. And so you can imagine it's a perfect storm in which you have a lot of great applications and a lot of users that are looking to dip their toes into DeFi. especially institutional users that use Coinbase. I'm guessing if their first foray wasn't into something like ETH DeFi or L2s, that maybe it's Base specifically because they feel more comfortable. So yeah, I think there's a good chance that Base does really well out the jump in terms of TVL, and that as a result, the alts on the back of that do really well as well.
Do you think it'll be a fully permissionless chain? Like, can anybody just go build there, and can anybody just go use there? Because I'm torn on. First of all, has anyone heard if like they've made an official statement that's like, here's the answer to how you use Base?
I know that the team came out and said that it is going to be fully permissionless. So I do think that anyone can build there if they want to and launch whatever dApp. The only thing is, though, I think Coinbase is taking this approach because in the past they've tried going to the SEC, talking about like how should we actually register some of these token listings? Like how does this work? So I think now they're doing the opposite approach. I think they're like, you know what, we're just going to do it and then deal with the repercussions afterwards. So I could see a world where it gets a little crazy, and then all of a sudden the SEC is coming after Coinbase, and Coinbase is forced to maybe censor some transactions and only include KYC users or something among the sorts. But I think off the rip, it'll be as permissionless as OP itself or Arbitrum or really any other chain.
All right. Well, that's definitely great to hear. And it's like, yeah, it'll be interesting to see if like, meme coins would have been such a topic in the beginning half of this year, largely just because of how bored everybody's been in the depths of a bear market. But it would just be funny if like there's meme coins ripping on this, centralized providers L2. That just sounds so funny to me. Like if you think of meme coins as this like, true casino, it's like a pure form of a casino. I think the 1000X guys, even brought up the fact there's like $75 billion of gambling spend annually lottery ticket spending strictly in the US annually, which is a crazy number. And like, if you think of meme coins as just like the same type of thing, you're effectively buying a scratch off when you don't know if it's a rug or not. It'd just be funny to have that type of activity happening on Coinbase's L2. So it'll be interesting to see if they try to guide a certain class of builder there. Like, I've seen Jesse tweeting about like, hey, if you need ETH or Gorley ETH on Base to go, make some work on testnet, basically test out an idea, go for it. I got you. Send me your ENS. I'll give you some ETH to go build. And so they've been like actively trying to bring in that class of builder. That's like here right now. And so like that's definitely the builder trying to build something super interesting and here for the long term as opposed to something short term and scammy, which is interesting because if you think about the legal repercussions, as you mentioned, Sam, it's like, is Coinbase going to be viewed as responsible for any illicit activity going on Base? Like they probably shouldn't be, but at the end of the day, they're likely going to be the sole sequencer operator. So how does that work?
I think for Base, one thing that I think about is obviously it's going to be like operated by Coinbase. The single sequencer is going to be permissionless. And on one hand, you could say, hey, all of these protocols are going to want to fork and launch on Base because it's like the like quote unquote institutional chain. It's going to have 110 million KYC users that can come from Coinbase Exchange. But I wonder if there's maybe an alternative version of this where a protocol goes, hey, like Coinbase is launching this, they're a public company, they're under SEC scrutiny. Maybe I don't want to launch on Base because if something happens to Base, I get swept up in this whole thing. And like, I don't know, maybe Base becomes a fully like permission regulatory chain. And suddenly I've been operating on there without like a money transmitter license because I facilitate lending, borrowing or something of that sort. I think that's definitely an angle to this. And I think another thing that I think about is what are the types of new protocols that are going to launch on Base? For sure, on day one, there's going to be like 20 different blue chip DeFi protocols that are just going to fork and launch on Base. But I'm super curious as to what are the new protocols that will launch on Base look like. Is it just going to be your standard, like you have your perf stacks, your concentrated liquidity, like AMM? Or are we going to get some real innovation that sort of integrates to the 110 million KYC users that Coinbase has, or something that actually like has value in the real world rather than just trading or gambling?
Yeah, that's a great point, Ren. Like, I think about gaming quite a bit for something I don't know much about, like specifically in the on-chain gaming realm. We just saw Framework do another $10 million round into Illuvium, or they led that round. I don't know if they took the whole round, but nonetheless, like they're always talking about gaming, and they're some of the best in the space. So it's interesting to see if like Coinbase will take that gaming approach, considering like they already have this thing that nobody else has, which is users. A ton of people use the Coinbase app. They're going to start pushing people into the Coinbase wallet, and then you're right there. You're probably the default place, the default chain you'll probably be using within the Coinbase app at some point will be Base. And so, yeah, sure, you can go change it yourself, but most people don't know that right out of the gates. So it's like going to be really interesting to see how they funnel from the Coinbase application to the Coinbase wallet to Base. I feel like that's kind of their top of market funnel. So it'll be super interesting to watch this one play out.
Yeah, I actually already noticed the other day that Coinbase's app has like a top games kind of like list. So like I feel like that could easily be one of the things for Base, like because that's a way to circumnavigate kind of the app store debacle, because like you kind of have a little mini app store within the Coinbase app itself. So curious if Apple would be smart enough to catch onto that little loophole, but nonetheless, yeah, I agree with your take there, Dan, that I think gaming is a pretty prime candidate for Base. I feel like we hit that one pretty well, though. Dan, do you want to go with your back half prediction?
Yeah, so I wrote about the flippening back in the end of 2022, and I still believe in it. Actually, I do. Even though I quite literally top ticked the ETH BTC chart with my my tweet thread on kind of explaining why. It's quite literally been down only since the day of the tweet, but nonetheless, it still just makes sense to me. So if we think about things going on Bitcoin, it's maturing, it's getting, used more. We're seeing more activity. It's had the recent rise of ordinals, which has been an exciting development. But ordinals are, I get them. They make sense, and they're something to do on Bitcoin. But they still feel very gimmicky and don't seem to have any practical purpose at all, which is just seems like it's not going to work. So example of that is like if I want to buy 1,000 Pepe and there's not 1,000 Pepe available for sale, I have to buy like 3 lots that equal 1,000 Pepe to just like total that out. Conversely, if I want to sell 1,000 of whatever meme token there is, then someone has to buy that entire lot out of me. You can't like break it up. And that's just like obviously not a scalable way to have anything. It's not a token standard. It's not like an ERC20 where you actually have individual tokens. So it's just like feels like you're shoving a square peg in a round hole. I think we've said that a couple of times now, but so to me, ordinals like aren't truly lasting. And I'll throw this chart in the show notes, but what we have is a Bitcoin miner revenue chart. And if you look at that historically and say, all right, well, what percentage of the total Bitcoin miner revenue fees were from transaction fees versus block subsidies? And I will say this is a nod in the direction of the anti-flippening crowd that just this month in May, the total block subsidy fell to like nearly all-time lows. We haven't seen this since March 2021, so peak bull market, where block subsidies were actually only 86% of the total revenue generated by the miners. So in last month, ordinal fees were 4%, and other transaction fees, so anything not involving an ordinal, was about 9.5%. So that is a pretty notable stat for the depths of a bear market. However, I just don't. Again, I don't believe in the ordinals being this long-term solution. So this feels more of like a flash in the pan for me. And again, the fact that we're celebrating the nearly all-time high of transaction fees as a percentage of total miner revenue around 14-15%. That says a lot about a chain that's been around for 10 years. And I just don't love the direction of that narrative as the chain continues to mature and the block subsidies continue to push closer to the next halving. Granted, that's been a very, very bullish event over the last, the entire history of crypto. But I do expect that narrative to change at some point. It's like, oh no, the halving's coming again, which means Bitcoin miners are going to start losing revenue. Now, very importantly, I got in a ton of Twitter battles over this. It's like, that doesn't mean that Bitcoin is dying. That is not, it is built for this exact scenario. It just makes its value proposition less interesting. And as everybody in this space knows, narratives matter. And if you have these dying or these decreasing block subsidies, it becomes less attractive to mine the chain, and miners start dropping off of the network because it's not profitable to be there for them, which again does not kill Bitcoin. That's just an equilibrium where it finds balance until miners drop off, and that it pushes the profitability of the remaining miners up to a point where they're making money again. And that's fine. Those economies will work. But again, that'll get taken out of proportion and ruin this Bitcoin first narrative. Now, you take that's kind of how I view Bitcoin right now. And when you think about Ethereum, successful upgrade to proof of stake, successful Shanghai Shapella upgrade that kind of hardened the proof of stake by enabling withdrawals, and proto dank sharding on the way. That is a phenomenal progress that the chain has made over the last 6 to 12 months, and will do so for another 6 to 12 months. That enables it to further reach its vision of this, roll-up centric roadmap. So it's going to have positive catalyst after positive catalyst. And when you look at how validators are doing over in that ecosystem, growth has been up and to the right. If we just look at the last 3 quarters, so Q4 of 2022, Q1 of 23, and the current quarter, Q2, we've seen continued quarter-over-quarter growth for not only ETH holders, but also ETH stakers. So if you think about like a value flow to ETH holders, that's basically their net dilution. So the amount that was burned in this period versus the amount of ETH issued, because ETH issuance does dilute a holder. We've seen this number grow significantly quarter-over-quarter. In Q4 2022, the net value flow is around 5,000 ETH, whereas in the current quarter, which isn't even over, it's only about 2/3 of the way done. There's been a net value flow of about 207,000 ETH, so about 200 times higher. And so that's where things get more interesting to me. Is like, all right, well, we have this more. Sorry, that's 40 times, not 200 times. Nonetheless, it has more interesting narratives where holders and stakers are generating profit and earning yield. So now it has the yield narrative. Ren mentioned the importance of this like on-chain native yield. Is like, well, is it really a risk-free yield? Probably not, but what does it actually mean? That'll just get propagated. And we recently talked to the Bitwise, our folks from Bitwise, and they were like, okay, well, yes, we have this new narrative around Ethereum, and like, yes, it's building this roadmap out, but institutions are still a little hesitant. It's not like they're all just chucking cash into staked ETH and calling it a day, or running their own validators, but they're like, okay, let's check it out. Like, there's been a sentiment change. It's like, all right, we get something's going on here. Let's investigate it, but we're not ready to commit capital. That is a sentiment change that I think is worthy of kind of pushing this trend forward. And then lastly, you have like this ESG narrative of like proof of work versus proof of stake. Personally, I think that's like bogus, but if that's what Wall Street wants to propagate, then we'll happily be here for it. So I don't know. To me, it feels like there's just a ton of positive tailwinds for Ethereum, and honestly, some headwinds that Bitcoin's going to have to deal with and innovate on. And I think that just bodes well for the future growth of Ethereum relative to Bitcoin. But curious to hear your guys' take on it.
Yeah, I mean, you already know I strongly agree with you here. And I think just put simply, it comes down to flows, like you said. Like if you look at the supply side, proof of work versus proof of stake, you obviously see billions of dollars in sell pressure that's not emitted through proof of stake, that is through proof of work. And then you have things like EIP 1559, where the supply of ETH is actually deflationary in most cases, and has been this year to a large degree. And then on the demand side, like you said, ETH itself has a lot more utility. Not only uses the gas token, but as we see LSTs within DeFi grow, the utility to capture that yield and use those LSTs in whatever way possible just continues to get heightened, whereas Bitcoin, sort of its only utility is sending it from one address to another. And so just because of those flows, because of the decrease in supply and increase in demand, I just think over time it's inevitable. And I know these predictions were supposed to be for the back half of 2023. I don't know, Dan, if that's your timeline for the flippening. I think that's a little too early. but I think eventually it is inevitable.
Okay. Great point. Maybe I cheated a little bit because I even kind of cheated in the 2023 prediction. I said before the end of the next cycle. And yeah, like I don't think that like I don't even think Bitcoin's going anywhere. It's just that it won't be the most valuable asset. I think the base layer of a globally distributed financial medium is a more attractive value proposition than something that wants to be money, but I think has flaws in being money. So that's just kind of my view. And again, I think thank you for pointing that out. I do not think this will happen before the end of 2023. But when we're at the height of next cycle, this might be a great top signal where the flippening happens. It's like, this is peak euphoria because you probably got that next wave of institutional capital that was like, all right, let's investigate this yield thing. Now's the time, which again is probably going to be a great top signal. But and I'm sure there'll be a long-standing battle between the two at some point after the initial flippening is made, where maybe it gives it back up and takes it again. Like that's kind of how I expect this to play out. I don't expect it to be a flippening next month and never looked back type scenario.
Yeah, I think it'll probably be 2 more cycles before we see a flippening, but I do think it'll happen eventually. And mainly it just stems from like they're tackling really 2 different problems. Like I don't think the average person actually looks at the current monetary system and thinks there's much of a problem. And that's exactly what Bitcoin is trying to solve with a predictable monetary supply. And like even in a world where we did see hyperinflation of the US dollar, I think that the on and off ramps to crypto would be shut off. So like crypto's primary use case Bitcoin's primary use case, in my personal opinion, like is just a tough one to actually be fulfilled like within the next 2 cycles. So let's call it 6-7 years versus Ethereum. Like it makes a lot of sense to a lot of investors. It's like, well, what can you do with Ethereum? It's like you can build actually better products that are cheaper, faster, and better for consumers on top of blockchains. So like strongly agree with your prediction. I just think it's going to take a little bit longer to play out.
I think one thing that people that maybe like started their career in crypto or like their first introduction or foray with finances crypto don't realize is that there's a huge amount of idle capital out there that's chasing yield. Like as I grew up, the more I realized like, holy shit, people are like so rich and there's so much money out there. And there's like a lot of rich people that are a lot richer than you think. It's like mentally you may just think like, yeah, sure, like Elon Musk, like Jeff Bezos, but there's like a lot of money out there that's chasing yield. And over the years, you've seen people sort of like go up further and further the risk curve to chase that yield. And after that, that potentially basically sometimes it blows up, right? Like there's some carry trades that have blown up in the past. But all of that's to say that as institutions come in, right? I'm probably not an ETH maxi at this point. I wouldn't say I am. But as institutions come in, you're probably going to see a few like crypto tokens as the core assets that potentially one day may have like $1 trillion or like 10, okay, maybe not 10 trillion, but $1 trillion market cap. And you're going to think to yourself, okay, this asset seems like a good index bet. And I can get like a pretty sustainable and a pretty standard yield on it. And I think that's a fantastic value proposition.
Yeah, Ren, I'm with you there as well. And, I think we'll see it. I think we'll see it, like I said, next cycle or this coming cycle. But, like any good man says, if you're wrong, just push back the time horizon. So on that note, Westy, what do you got for us?
Yeah, my prediction is definitely related, although bringing in the time frame a little bit. But yeah, my prediction is that the hottest sector for the rest of the year by far will be LSTFi or LSDFi, however you say it. Yeah, I think just other sectors as a whole are sort of seeing a lull. Like the ZK EVMs aren't really seeing adoption. Like a lot of stuff that we thought we were going to see hype with this year really haven't delivered. And I think LSTFi really has. Like throughout the beginning of the year, we saw LSDs with a lot of adoption heading into Chapella. And now we're seeing a lot of really cool DeFi products built around LSTs. And so I think that momentum is going to continue throughout the rest of the year. I think looking at Libra, I think is how you pronounce it, as like a great example of like a protocol that's done really well. So like the past couple of weeks, it's grown to 200 million in TVL like really quickly, and just with like a little bit of farming incentives. So you can imagine that's sort of like a small spark that really incentivized a lot of LST capital to come to that protocol. You can only imagine once we get models that are a little more sustainable, in my opinion, that like once those catch on, they're going to really catch on throughout the rest of the year. And I recently wrote a report on the LSTFi sector in its current state at the moment and identified like 5 broad sectors, and I think each of them will grow. So the first was leverage staking, which has been popularized by Aave, where essentially like you loop your leverage around the LST and are able to capture more yield that way at higher risk. And we had Gearbox as of recent that developed their own leverage staking strategy as well. And I can imagine that a lot of vaults continue to pop up throughout the year, especially now that we have Llama with Curve. I think there's going to be a lot of great products there because they're prioritizing LSTs as the primary collateral. So I think that'll grow a lot. AMM liquidity, I think, is pretty straightforward. Whichever AMM can capture the most amount of LSTs by maximizing yield, I think they're going to capture a lot of market share. And right now, because of Frax's plug into the Curve Convex flywheel, I think they're going to do really well in that space. And Convex, like right now, is the majority player, but I think Balancer and Aura are giving them a run for their money. The LST baskets, I think, are a really good place for innovation. You have stuff like Unsheath, which has sort of like a basket underneath their LST, and they're creating new protocols. Although right now it looks like that there may be a security vulnerability. Hopefully they figure that out. But nonetheless, like definitely a lot of experimentation going on there. And you can imagine sort of in a convex type style where if you have a large sort of base of these LSTs, you can build new products, develop new yield strategies that maybe otherwise weren't possible without that backing. And then you have stablecoin collateral. So like I said, Libra has been growing really well. And you have other ones such as Prisma and other liquidity forks that are coming soon that I think are going to spark a lot of innovation, a lot of excitement there. And then interest rate derivatives, I think, are the final sector. And those, I don't think we'll see a lot of adoption this year. But as we discussed earlier, as the staking yield maybe becomes sort of like the risk-free rate within crypto itself, that there needs to be a way to both trade that yield as well as sort of go between the variable yield and potentially stable yield as well. So I think the LSTFi sector as a whole is going to grow a lot throughout the rest of the year.
Yeah, strongly agree with you there, Westy. And the interest rate stuff seems super interesting to me just because of how prevalent that is in traditional finance. I actually grouped this into options though. It's like they're super complicated financial instruments that can add a ton of value, but to a very specific class of people. And that specific class of people isn't on chain today, and I don't think we'll be on chain tomorrow. But I do think they'll be here eventually. And so for that reason, I'm like just a little bearish on the usage of those things in the coming short to medium term. But you mentioned a ton of other really interesting things there that we should unpack. And as you mentioned, yeah, Unsheath is down like 60% on the day. I think they paused withdrawals. This is a developing situation. I really don't know the extent of what's going on there, but they must have had some issue related to their withdrawal mechanism and have paused those right now. So sad to see that one go. But that's a kind of highlight. That's going to highlight of. I expect to see a lot of this going forward, and people just essentially taking LSTs, doing something with them, whether it's like leveraging the yield or some product that they can attract and grow capital into. You're going to see a ton of rapid growth, and you're going to see projects fizzle out for, again, just trying to capitalize on that rapid growth while sacrificing maybe some of the slow and steady growth that you tend to see from some of these larger, more dominant protocols. But is there a particular area that you're most excited about, Westy?
Yeah, for me, the area I'm most excited about is sort of using LST as a stablecoin collateral, because I mean, if you look at liquidity in its current form, you can only have ETH as collateral and you have 0% interest loans. And you can imagine if you apply that to LSTs, you can have not only 0% interest rates borrowing against your LSTs, but you can imagine because of the stablecoin infrastructure we've built around Curve and Convex, Balancer and Aura, et cetera, that you can have really high yields for the stablecoin as well. So you can build sort of like an ultra DeFi protocol that has yield not only on the collateral end, but on the stablecoin end. And so I think something along those lines is going to do extremely well, if not multiple protocols. And that's probably the area that has the most growth and is not as straightforward as something like leverage staking, where you just find different ways to leverage your assets. Like I think there's going to be a lot of creativity in this area.
Yeah, strong second on the stablecoin backed by LSTs. I would love to see a protocol with a super long-term vision actually set aside some of the yield on the LSTs into an insurance fund, and then after that compounds for like 10, 20 years. There's some really interesting stuff you'd be able to do on the more under collateralized lending side, but not sure we'll actually get that. But one thing's for sure, we definitely need like a decentralized stablecoin. So I'm definitely rooting for that there. But my question for you on that theory, Westy, would be, so obviously Maker has like the PSM in order to keep DAI at the peg, because back in May of 2020 or whatever it was, we saw a big liquidation cascade. Everyone had to buy back DAI. DAI price went up, which made it more expensive to close loans. I foresee the same problem happening here without a PSM type module with USDC or USDT to be able to keep the peg strong. Do you have any thoughts on that and how to circumvent that while maintaining decentralization?
Yeah, that's definitely a good point, and that's why I don't think Libra is necessarily a sustainable model, because they're hard pegging to USD, and there's really nothing stopping, especially the US dollar stablecoin, from trading above peg, especially because it has inherent yield. And from there, you can sort of get a liquidation cascade as the value goes up, the value of the health factor of the loans go down, and all of a sudden you have a large liquidation cascade, which is obviously not good. But in other models, you can imagine maybe not hard pegging to the US dollar, maybe having some sort of floating peg. You can imagine potentially having a PSM with maybe DAI specifically, because now you have the savings rate, and sort of like an LST backed loan, you can have sort of a DAI backed loan. And in that sense, you can still have yield as collateral and have like a better pegging that way. But yeah, overall, and also there's another model. I don't know if you guys have heard of Cat in the Box, but essentially rather than like a US dollar stablecoin, it's an ETH stablecoin. And in that way, you can have better capital efficiency because you can borrow at like a pretty high LTV, and it's not like hard peg to ETH. It's pretty soft pegs. So like there's a lot of creativity that can go into these things. And yeah, like you said, you have to be careful to hard peg. If you hard peg, like to make sure there's some sort of PSM or way to stabilize things. But overall, I think that's why I'm most excited about this industry, is because like there's a lot of creativity that can go into these models.
I think one interesting thing to watch for LSTFi over the coming years is whether ETH interest rates are more efficient than US dollar interest rates on chain. I haven't really thought through whether that would be indicative of anything, but in a purely like efficient market, the cost to borrow ETH on Aave should be the same as the staking you'd receive on ETH, right? And just off of the top of my head, I think ETH interest rates being more like in sync across like different chains or different protocols may actually indicate sort of like a more, I don't know, like moneyness or like more riskless component to ETH compared to USDC or like some other stablecoin, if those stablecoins were less like efficient or in sync in terms of interest rates on chain. I think that'd be a very interesting dynamic to stay tuned for.
Yeah, that is a pretty interesting to think about, Ren. I kind of like thinking about that as well, right? Just because the looping trade has been so popular on things like Aave, because you can borrow ETH for less than you're going to earn on the LST. So you're actually like, by looping it, you're still earning profit. But eventually there'll be a point where that's a non-profitable venture, because the cost to borrow the ETH from the pool will be equal to or close enough to the ETH staking yield that's just not a profitable strategy to execute anymore. And that's likely the direction we're going, I would have to think, just as markets get more efficient. And I mean, there's just money on the table for people to kind of get involved with and take in a relatively low risk way. So yeah, I don't really expect to see this inefficiency last for too much longer. Westy, one more thing on this note I want to get your take on is, we've seen LSTs really, really grab a hold of the lending market, but they haven't really come much into the forefront of the DEX market. So you still see a lot of the more popular pairs have ETH or USDC. Do you think there's a state where an LST token itself becomes like the most popular base pair?
Yeah, I definitely see that future happening, just because like as an LP, you're going to want to accrue as much yield as possible. And if one of your assets is sort of that like automatic rebasing token where the price, you get more of a relative ETH to the LSD that you have, like I think that's just like a no-brainer in most people's brains. I think the question is, which LSD is the one that like is able to capture that market. I think Wrap Stake ETH has a good chance of capturing a lot of that on Uniswap. I think staked Frax ETH has a really good chance of doing that within Curve and Convex, and then potentially Rocket Pool ETH within Balancer and Aura. So I don't think it's going to be a winner take all. I think there's going to be a lot of different pools with different LSTs in this area, but I agree that it just makes sense to have the asset paired with like an LST rather than wrapped ETH. And so, yeah, over time, I think as people trust these LSTs more, as there's more liquidity, it's sort of going to become a flywheel, and they're definitely going to be the most used asset within these pools.
No, that's a super interesting take, because I always hear people talk about this, how it's like for sure going to be this winner take all scenario. Staked ETH has such an advantage because Lido just has so much market share right now. And that's kind of seems to be like, I guess, maybe even the middle of the bell curve take. But you had a great point. And I actually have a flip side dashboard out there that kind of highlights all of this, but different LSTs have very different dominance levels on different decentralized exchanges. And that is an excellent point about how each DEX might have its own more popular pair. I'm going to play around with that idea. That's something really interesting to think about.
Yeah, you just know Frax isn't going to allow Wrap Staked ETH to be a majority pair on any pool within Convex. And so
right. And they got the firepower to make it a problem for Lido. And Lido's like, they have a close relationship with the Curve. They should want to continue that relationship going. They have 1.6 or $7 billion of staked ETH on Curve, and Curve pools don't need to actually have the wrap staked ETH. You can still use the rebasing token in the pools, and LPs still get the rewards, which is unlike most other DEXs. So yeah, this is a super interesting concept. We should dive into this more. Probably a good place to pivot here. Ren, what do you have for your 2023 prediction?
My rest of the 2023 prediction is that CCTP, Circle's cross-chain transfer protocol, will be utilized in more than 85% of USDC transaction volume by year end. So for those that are unfamiliar, CCTP is basically a cross-chain infrastructure protocol where anyone can permissionlessly mint and burn native USDC on supported blockchains. As of today, it's only Ethereum and Avalanche, but by the end of the year, Circle is planning on supporting a few more blockchains, including Solana and other chains that they have native USDC on. Basically, USDC represents a much better value proposition for a few reasons. Number one, you're getting native USDC on the destination chain rather than a wrapped version of USDC. Number two, you have sort of a change in the trust assumptions from whatever bridge that you were originally using to Circle. And after all of the bridge hacks of 2021 and 2022, probably 2.5 billion or 3 billion has been gone by now. It's possible that users are going to trust Circle more than whatever bridge that they were originally using, especially if they're minting wrapped versions of those assets. And the two largest stablecoins today, right? USDT, USDC. I think people often forget that USDT, even though it has a much higher market cap, like 80 billion, probably 50 or 60 billion of that is just sitting on Tron and just farming or just like skirting Chinese capital controls, and it doesn't really go outside of the Tron network. Whereas USDC, for most of like the large bridges today, represent between 30 and 60% of transaction volumes. And so because it represents a better value proposition and it basically represents a better bridge execution method, I think that's going to significantly change how bridges will basically generate their revenue. The key point here is that bridges will probably make less money, and they're going to have to integrate CCTP because it just provides a vastly better execution here. There is a small caveat here that USDC and CCTP, you need to wait a longer time because you need to wait for finality on your origin chain, whereas some bridges out there, for example, Synapse, you only wait like 20 seconds sometimes if you want to do like a USDC bridge transaction. And so there's still going to be like a range of preferences, right? Maybe you don't want to wait 15 minutes. Maybe you only want to wait 20 seconds. But overall, I still hold true to my thesis that I think CCTP is going to be utilized in more than 85, if not 90% of USDC transaction, bridge transaction volume by year end.
Yeah, I think it's important too to distinguish that you meant bridge transaction volume, because obviously there's a hell of a lot of raw transaction volume of USDC. But yeah, I strongly agree with you, Ren. I mean, the way I see it is like, why would I lock up ETH on Ethereum and then mint a wrapped asset on Avalanche and take on that bridge risk when I can just go via USDC and know that I have Circle backing that transaction? Like, there's just no competition there. It's going to be by far the most secure way to bridge. It'll probably be one of the cheapest. That's for sure the only way I'll be doing it.
Yeah, I'm with you as well. It's like, if I'm not worried about Circle freezing my money in the middle of this transfer, then I don't see why you wouldn't do this, to be honest. It'll be your most secure way. And like anybody that's bridged before knows the stress of, at least with like on-chain transfers, even though it can still be stressful, especially the first couple of times you do it, you at least get like Etherscan loaded up and you can see it like pending. Everybody knows those bridge explorers don't quite work the same. And you have those moments of like, where the hell is my transaction? Yeah, flashbacks to bridging to Canto before the UI was even live. But nonetheless, it's like, this just seems like a serious improvement. And even things like Thorchain, which kind of takes a different approach and is strictly native assets, you still have exposure to the structure of the system while your bridge is being, or your bridge transaction is being executed. And so like, I've used Thorchain quite a bit. I deeply love what they're doing. They can actually connect to Bitcoin, which is super cool, and nobody else can really hold water with that as well. But this still just feels like a better way to do it to me. I'm with you. I think we're going to see high usage of this, Ren.
I think one thing that I'd like to add is that, sure, today, like a lot of bridge volume comes in the form of ETH. Maybe, I don't know, 30 to 50% of bridge volume is still in ETH. But I want to bet that the actual like 1 billion users, if we ever reach mass adoption, most of them are going to use a stable coin and they're going to denominate their transactions in stable coins rather than ETH. And, you know, with things like DYDX before coming on to Cosmos and they use USDC for collateral, native USDC coming to both Cosmos and Celestia rollups, I think USDC could become the stable coin of choice for everyone, you know. And at that point, if USDC becomes a stable coin of choice, there was another thought that I had while writing my most recent report. Definitely go check that out if you haven't. That basically people don't really want to provide bridge liquidity anymore, because with USDC, anything that's paired with USDC in a DEX liquidity pool basically becomes bridge liquidity, and it becomes native bridge liquidity, right? So, for example, ETH USDC is probably the most liquid pairs on most blockchains today, maybe other than like ARB, ETH, like whatever like native like token of that blockchain is. And over time, if you think about it, with CCTP coming online, if someone wants to make a cross-chain swap, rather than using a bridge where someone else has to provide that liquidity, USDC can act as an intermediary, and you can basically make a cross-chain swap using a DEX on chain 1 and another DEX on chain 2. And I think that's a sort of like big mental model unlock that I had while writing this report, that I'm not saying like bridges are dead. I'm just saying they may need to review their either like security models or revenue models, because they don't even need like USDC liquidity anymore. Like, for example, Synapse, right? They use a curve stable swap formula to basically balance their proofs and price a cross-chain swap or bridge transaction. But they have plans on integrating CCTP for USDC transactions. And if you don't need USDC liquidity, how are like Synapse stable swap proofs gonna function? They're probably gonna need to relaunch them without USDC, which I think is also an interesting implication of CCTP. So definitely look very hard at your bridge tokens and how you think they're gonna perform over the next 1 or 2 years.
It's going to be a base filled year. The flipping's still on the table. LSTFi is going to be the chief narrative. I strongly agree with that take, Westy. And CCTP is going to eat the bridges. or at least can force them to reevaluate their business models. So that's kind of what we're thinking, and that's us kind of look into our heads of what we're thinking about the next 6 months. Want to give another shout out to the Atom Accelerator. Be sure to check them out. We love what they're doing over there for the Cosmos ecosystem and the Atom economic zone. So be sure to give them a check out. But that's going to be it from us, guys. We will see you next week.